So once again, welcome you all to today's section. We are going to continue with the question that we are looking at Asempa Limited. Good. We reached the step number 6. That's the preparation of the resultant statement of financial position. That's where we ended our last meeting. So as usual, the three protocols. So right, Asempa Limited here, we are doing step 6. So Asempa Limited, then tell the examiner that resulted or resultant statement of financial position, as at we have to code the date or just after the scheme. You can make it financial position just after the scheme. Or if you know the financial position date, usually the next day. So let's go and pick the question, look for the dates. So you can include dates, or you can also state it as just after the scheme. So Asempa Limited. So the balance sheet date is as at 31st December 2011. So this should be 1st January 2012. So if you want to code dates, that's the date that you have to code. So let's go to the board. Great. So I will quote just after the scheme. So I'm not going to worry myself summarizing dates. No, not at all. Great. Okay. Great. So the resultant statement of financial position just after the scheme, because I don't want trouble. I don't want to go and then be calculating dates. If I get wrong, for submitted myself trouble. No. So financial position just good. So just after the scheme. Line it. Don't forget your 3 protocols. So currency, division traders, you bring it there. Now, if you know the format already, kindly go by the format, the standard format. All asset one side, equity plus liabilities also at the other side. All assets, both current, non-current. But if you are not familiar with this format, then don't worry. Just follow the format that they have in their question. So how the examiner stated it, the same way we have to also move by that. But if you are okay with this style, why not go by this and then you are done. So take note. So I'll go by this method. All assets must equal to equity plus liability. Don't forget that the balance sheet presentation, there are 2 methods. This method 1, we call it total asset method. This method is called total asset. We have a second method called net asset method. That one, the non-current assets plus the capital employed plus the working capital must equal to the capital employed. So that's equity plus non-current liability. That's another star. So that is it. So let's see. I'll start with non-current assets as usual. All the non-current assets. So non-current assets. Here, pick all the going concern values. All the going concern values. So as they've arranged it in the question, that is how we will go by. And kindly pick the going concern values for those that you want to pick. So going concern values, it should be the best figure. So when you go to avoid oversight, just check all these assets: freehold property, plant, machinery, and motor vehicles. So I'll write them first. Freehold property. All right, freehold property. No shortcut. Next one is plant, machinery, and motor vehicle. Then I have to pick the going concern values. I will not select that of deferred development expenditure because it has been what? Disposed of. We sold it. We sold it. So that is it. We sold it. We sold that figure. So we don't need to include it. Instead, we advise them to acquire new production plants, right? So the new plants, you can show the new plants, or you can add it to the existing plants. But you can also write here new plants, but you can add it to the existing plants. That's all. So the freehold and plants kind of give me the going concern values. And you can see this one in the step number 2, the going concern value. So that is it. Or here we pick the liquidated values, which is the for freehold property. We had something like 1490. Agreed. Okay. So that's the first note. It's 4,000, right? So kindly, if you have your solution with you coming from the workings number 2, that is the step 2, determination of maximum loss, go there and pick the going concern value under the freehold property. Now, one thing about this financial position preparation is that all the figures that will come here, you've worked on it before. None of the figures that you've not worked on it, all the figures that are coming here. So all these figures, they have a source. So don't need to worry again searching through the question. Through the question somewhere, just bring the figures. You've worked with them. Freehold, all these standard going concern values. So going concern value, I'll go there and go and pick it. This new plant is another resource requirement. That's why we said they should acquire it, right? Good. So let's see. So what are the figures? So this one will be 4,000. So we had 4,000. So you can confirm for me. Then we had 900. Then we had 900 for that of the machinery and motor vehicle. So I put a 900 in here. Then the new plants. What was the figure? Who can remind us? So the plants, 3,500. That's the new plant. That's all about non-current assets. You are done. You sum them up. It's like you can also follow them. When they move, you move. When they stop, you stop. But if you know the format already, you can go by your own format. That's the total assets method. So let's sum all this one up. So this one will give us 4,800. So 8,800. Agreed. Okay, great. Then you go to your current assets. Your current assets. Now in the current assets, you know them already. So current assets. What are they? Number one on the list will be your inventory. Inventory. And what's the going concern value for the inventory? It was 2020. You take your receivable, account receivable, or the trade receivable. So trade receivable. Let's go and pick how the examiner calls the said account receivable. Because solution to every question is the question itself. The stated account receivable. So here too, we have to also call it account receivable. No shortcut to. It was 660 going concern value. Pick the going concern values. Then here, you write your cash, the cash balance. Cash balance. Into bracket, that is a working capital requirement. Working capital requirement. What do we get for that one? The working capital requirement. I wish you can put that section on repeat. That is how we had the working capital. Good. So working capital is 1320. Perfect. So putting all this together, you get 4,000, right? Because we had 4,000 there. If you add all, you should also get 4,000 cedis. You should get 4,000 cedis. So what do you get? 4,000 automatic. 4,000. What is the total assets? What will be the total assets? So total assets will be total assets. Now give us 12,800. Total assets will be 12,800. That's the current plus what? Non-current. So 12,800. You double and align it. Then you continue again. So let's continue on the other hand. Let's continue here, okay? You go to equity and liabilities. So equity. Equity and liabilities. Equity and liabilities. You start with the stated capital, ordinary share. So you start with the stated capital. Now with the stated capital, you start with the ordinary shares, the OD shares. Now, here you have to open a bracket. Original position minus what they are losing plus what they are bringing, the additional funds. In this question, we don't have, for this and this will give us 0. They are losing everything. So they are losing all what they have, the original position. So in this question, we will just pick what they are bringing, then we are done. So ordinary shareholders, in fact, if you pick the equity section, ordinary shareholders, what's their position? So let's go to the question and then pick their position before. So ordinary shareholders, their position before is in the last footnote, 5,730. So if ordinary shareholders, they have 5,730. How much are they losing? They are losing everything. So if they are losing everything, then our subtract is 5,730. How much are they bringing? They are bringing 3 million. So plus 3,000, whatever they are bringing. So plus 3,000. So that is the how the ordinary share capital look like. But because they lost everything, then their position will be 0 plus whatever they are bringing. That's all. So you can just put 3,000 here as the ordinary share capital. And this is the composition. Great. Their position before, whatever they are losing plus whatever they are bringing, you are done. Their position before, whatever they are losing, just like here, they are losing everything plus what they are bringing. So that will give us 3 million or the 3,000. Perfect. So I will put it there straightforward as 3,000. I am done. And that is the interpretation of that. Then I'll go to preference shareholders. Them too, they lost everything. And then we asked them to bring what? 2,000 cities. So 2,000 here. They will also go through the same procedure. Their position before, they had 3,150. They lost this everything, so 3,150 plus what they brought, 2 million. So at the end of the day, to give them 2 million, and then you are done. Kindly take note of this. So how we got the 3 million and then the 2 million. Perfect. Your position before, whatever you are losing plus whatever you are bringing, you are done. Then here we don't have income stop loss. We have scrap it off. It has been cancelled. So no income stop loss. You are done with the equity. Then you go to your liabilities. So let's go to the liabilities. So there will be 5,000. Then you go to your liabilities. Let's start with the non-current liabilities. The non-current liabilities. Non-current liabilities. So non-current liabilities. In this question, it will be 2, right? First, go to the non-current liabilities. From the question, we have non-current liabilities. Why are you? There are 20% debentures. So 20% debentures. 20% debentures. That's 3,800. Then, is there any loan that we asked them or we converted? The bank overdrafts. We added more to it and now we had 4,000. And we said that this 4,000 is too much. So they should convert parts of it to be a 10% loan note. So 10% loan note coming from the bank overdrafts. The 2 million that we said they should convert. So here must be like this. Perfect. So that will be 2,000. That's all for non-current liability. Then you go to your current liability. So the current liability will be current liability here. If you go by the humble advice, it said I pay all and leave one. So in this question, we left only the bank overdrafts. So the overdraft, bank overdrafts. And even it's like this. They had 2,100. We took additional 1,009. Then we took 2,000 out. The bank overdraft left will be 2,000. Agreed. So that'll be something like this. So here will be 2,000. What is the total liabilities? Total liabilities. What will be the total liabilities? So total liability will be 3,800 plus 2,005 plus 2, making 7,800. This total liabilities. Then you go to equity and liabilities. So now this 7,800 plus the equity of 5,000. Basically, that should give us 12,800. You double underline, then you are done. Then you correctly write a name there. That's equity and liability. So total equity and liabilities. So we are done with the scheme, writing of a scheme. Don't forget the steps and then the proposal. It must be between 7 up to 10, maximum of 10, minimum of 7. Yeah, it's okay. Then you are done. Wait. If you do have any question, kindly let me have them. Let's quickly go through the question and let's see. So our next question that we'll look at it will be the 2020 capital reduction question. So we have posted it on the platform. So let's see. I hope it's a bit okay. It's not that clear, but what can we do? Okay. So I'll quickly go to the requirement. You are required to advise Mugu Bank whether they should support the capital reduction scheme or they should push for a forced liquidation. Support your advice with calculations, with relevant calculations, not just any calculation, relevant one. 5 marks. B, propose a scheme of capital reduction for consideration by the board of directors of Brighter Days Limited. That will be acceptable to Mugu Bank Limited. So design a scheme. There's a C part. For the C part, I did not add it to C part in the original question. The C part, where are you? The C part is on the other page. That page did not appear. So I'm reading the C part here. You can jot it down. Prepare a statement of financial position for Brighter Days Limited. Assuming your proposed capital reduction scheme is accepted and implemented, 5 marks, making 20. So there are 3 questions in there. So let's go to the entire story. The story starts like this. Brighter Days Limited has been trading unprofitably for some time now and has accumulated negative retained earnings. The board of directors have decided to restructure the company through a capital reduction scheme to prevent a forced liquidation. Mugu Bank had advanced a loan of 10 million to the company as a charge on the company's freehold land and building. This loan is part of the bank loans in the balance sheet. Okay, he has given 10 million, right? So let's go to the balance sheet. What is the loan? The loan is 23 million. The loan is 23. So Mugu, I've given what? 10 million. So if Mugu have given 10 million, so other people will be what? 13 million. 13 million. So if Mugu's percentage is what? 23, then if Mugu is 10 million, the entire loan is 23. Other people will be what? 13. Agreed. So now let's continue the game. The balance sheet of Brighter Days Limited as at 31st December 2019 is given below. What suggests that they are struggling? You go to the income support, it must be negative. Yes, this suggests that they are struggling. Okay, so that is it. Please, the income support is the same as what? Retained earnings. So take note. Even though here it was stated as what? Negative retained earnings. Even though it was stated as what? Negative retained earnings. Basically the same. So take note. Now let's come through. Let's go to the footnote and come to the financial position. All the assets are there, starting from freehold land and building up to and then development expenditure. All of them. Cash and bank balances. Great. So there's cash and bank balance here. We look at how we are going to treat it. Then, but all the financial statements are there. Let's go to the footnote. You have been provided with the following additional information. Brighter Days Limited stated capital consists of, as usual, ordinary share 30 million, cumulative preference share 10 million. No dividend was declared on preference shares for the year ended 31st December 2019. Okay, no dividend was declared. But they can have preference dividend in arrears. Let's see. This dividend is for preference shares, right? Great. The following non-current assets have the following values assigned to them. So thank God. They have given us net realizable value and the recoverable amount. They have a purpose. For liquidation, we say first, select disposal value, net disposal value, or for sale value, or liquidated value, or breakdown, or breakup value. If these items are not there, then you go to next, net realizable value. Next, then you go to the recoverable amount. Next, the value you use in that order. So for liquidation, in simple and short, for liquidation, we are using net realizable value. But for reconstruction, that's the maximum loss determination, we use the recoverable amount. You are done. Note 4. Brighter Days Limited investments to be sold at 5.5 million. So it should form part of the proceeds in terms of liquidation. And don't forget that they say they should sell it. So they have to. In the scheme, if you're looking for receipts and payment, this 5.5 million should form part of the receipts. Good. It is not probable that the development expenditure will generate future economic benefits. So that means in the going concern, it will not be part. There's no future economic benefit. So there's no what? Recoverable amount. Recoverable amount is what? Zero. NRV to zero. Everything zero. So automatically, the development expenditure will vanish. So in the new financial position, no deferred development expenditure. That is it. No, 6, 10% of the trade receivable is considered irrecoverable. So the 10% of it, you take it off. Good. Obsolete inventory amounting to 2 million is to be written off. So that means you take the 2 million from the cost so that you can get the NRV of the inventory. Then go to note 7. The bank overdraft. The last and the total, right? Okay, great. Wait, so no 7. The bank overdraft has been secured as what? Floating charge, like that, on all the assets of Bright Days Limited. The other bank loans, what's the other bank loans? Other than loans from Mugu Bank were secured as fixed charge on plant and equipment of Brighter Days. So that means here the fixed charge are two. The fixed charge liabilities are two. One, the one coming from Mugu Bank, they are 10 million is fixed charge on what? Freehold property. That's the land and building. That's the number one. Loan coming from Mugu Bank is a fixed charge, 10 million. Number two, the other loan, if the entire loan that we have is 23 and Mugu own is 10, then other person's own will be what? The other bank. That's 13 million. That one is what? Secured on plant and equipment. That's all. That's the meaning. So here the fixed charge liabilities are two. It can be many. Yes. Look at the asset that nobody have tagged. Tag your own on it. You are done. Now note 8. The company will require a current ratio of 2:1 to the trade satisfactorily if it is to continue as a going concern. The existing ordinary shareholders are willing to raise all needed working capital to meet the desired current ratio. I like that too. Wow. So that means here, if you are looking for somebody to be billed, take all and give it to the ordinary shareholders. They are ready to raise all needed. So don't ask preference shares to bring money. Do not ask anybody to bring money. The ordinary shareholders, they say they are willing to contribute. So when you go there looking for someone to pay, the receipt section, everything must be for what? Ordinary shareholders, apart from the 5.5 million that we see here. Great. Then that is all. That is all. Okay. So let's go to the requirement again. Advise Mugu Bank whether they should support the capital reduction scheme or they should push for a forced liquidation, supporting your advice with relevant calculation. Relevant. So that here they are just looking for the statement of liquidation, and after that you analyze the position of Mugu Bank and advise them. That's all. So if they are losing, and then they shouldn't push for liquidation, because upon liquidation they will lose. Oh. But if they are not losing anything, oh, then they should push for liquidation so that they'll get their money quick. Exactly. So let's start the game. Great. So first thing on the list, so first we have to tell the name of the company, Brighter Days Limited. Wow. So Brighter Days Limited. Brighter Days Limited. Brighter Days Limited. Then we are So Brighter Days Limited A. So Brighter Days Limited. Great. Then I write here statement of liquidation. First thing that I'll do. Statement of liquidation. No shortcuts. Don't forget your currency. Bring 2 in thousands. That is all we need. Then you write proceeds. If you pick the proceeds, we said that pick the paper. Let me see if I can have it here. Good. So this is it. So this is the paper. So hold it like this firmly. Your pen will be here like this. Then we said that pick the names of all the assets on the balance sheet. The name of all the assets on the balance sheet. So proceed. So let's go. Just the name of the assets. So first, freehold land and building. So that's the first one on the list. So freehold land, and building. The next asset on the list, this is what we were talking about. So go to the face. The first asset is freehold land. Second, plant and equipment, furniture and fittings. Investment, just their name. Then development expenditure. But because we've read the note before solving, they inform us that development expenditure should not be part. But don't worry. Inventory, receivable, and cash. So these are the items we're going to write. So let's quickly jot them down. So second, plant and equipment. So my plants and equipment. And next, furniture and fittings. Just their names though. The next, investment. Next, development expenditure. If I've read a note, don't bring it. But don't need to worry. We are writing all assets. All assets. Development expenditure. Next, inventory. So inventory. Next, trade receivable. Trade receivable. Next, cash. For the cash, you are allowed to pick the cash balance. The only item that you are allowed to select is the cash balance. So let's go. What's the cash balance? It's 1,000. So you select 1,000 there. So the cash balance, I'll trace it here and put 1,000 there. The rest, no. It must be in a footnote. Then you go to the footnotes to select the proceeds. We said first, as usual, select the sale value. If the sale value is not there, the same as disposal or for sale, break up, or liquidated values. If this one is not there, number 2, select the NRV. If NRV is not there, immediately select the recoverable amount. Recoverable amount. Then number 4, we said the value in use versus the fair value. That is all. Please, liquidation is like this. Then with the going concern values, that is the maximum loss, is the reverse. That one starts like this. So maximum loss, this one will be the first one, second, 3, and 4. How do you get it? So take notes of that. Okay. So let's go to the footnote and select them. So here, first notes stated that Bright Days Limited stated capital consists of this. So they're there. Doing that one. Note 2, dividend. No dividend was declared on preference shares for the year ended 31st March, 31st December 2019. Good. Then the following non-current liability, note 3, the following non-current assets have the following values assigned to them. So NRV is there, recoverable amount is there. So which one are you going to select? They're very close. So the margin is like here, have you seen? So take notes of that. So NRV will go. Then recover amount will be first for going concern. This one will be first for liquidated values. Then you are done. So let's go and select them. So freehold land is 8,000, plant and equipment 15,000 and 5,000 respectively. So 8, 15, 5. So 8,000, 15,000, and then 5,000. Then we move on to the next one. So if I arrange it well, they also follow the same order. Note 4, Brighter Days Limited investment is to be sold at 5.5 million. So that's 5,500. So here will be 5,500. Let's move on with the game. Then the next one, it is not probable that the development expenditure will generate future economic benefit. So they are not going to receive anything there. Chai, they can't sell it. Dash. They cannot sell it. So kindly bring dash there. They cannot sell it. So you bring dash there. Agreed. Take note of that. So then we move on to the next one, inventory, trade receivable, and cash. So let's do inventory and trade receivable. So let's move on with that one. Where are we now? So he said that 10% of the trade receivable is considered irrecoverable. So you can only receive what? 90%. So trade receivable, pick 90%. So let's go up and go and pick the trade receivable. Trade receivable here is 5,000. So you take 90% of 5,000. That's 4,500. So open a bracket like this. Tell the examiner that 90% of 5,000. Show all working correctly. 4,500. Agreed. Okay. Let me clean this one from there before it will scatter the arrangement. Okay. Now let's with inventory. Let's see inventory 2. Inventory 2 in the same note though. I said that an obsolete inventory amounting to 2 million is to be written off. So that means inventory figure, select 2,000 from it, subtract 2,000 from it, cancel 2,000 of the inventory. So inventories is 7,000. So if I take 2,000 off, you get what? 5,000. Perfect. So inventory will be 7,000 minus 2,000, and that will be 5,000. Perfect. Put all of them together. That's the total proceeds. So total proceeds. As usual, I start again. Distributed as follows. So kindly get me the total proceeds. So this is distributed as follows. Distributed as follows. So the total will be 8,000 plus 15, 20 plus 5, 25,000, 30,500, 35,500, 44,500. 44,500. 44,500. 44,500. I might not take that. Okay. Perfect. I'll take the, okay, great. 44,000, right? Great. So the total proceed is 44,000. Then we have to distribute this one. So distributed as follows. So let's go and share them. Up to the 5 classes of debts. First, liability with what? Fixed charge. Can I do that one at the other end there? Okay, let's continue from here. So first, liability with what? Liability with fixed charge. And then the fixed charge, once there are 2 in this question, so underline it. Go through the question, which of the liabilities carries a fixed charge? So first, we said that the Mugu Bank, their liability carries was fixed charge according to the examiner. So let's go there quickly. You can see it here. Mugu Bank had advanced a loan of 10 million to the company as a charge on the company's freehold land and building. So this is a fixed charge. Good. Fixed charge. Perfect. So let's continue the game. A fixed charge. Now the Mugu Bank, the loan that they've given is what? 10 million. Mugu Bank, their loan is what? 10 million. It was secured as a fixed charge on what? Land and building. So check the land and building. How much did you realize from the land and building? We realized what? 8 million. Meanwhile, the Mugu Bank, their loan is 10,000, secured on 8 million. So what do? What we realize is not enough. So it means that we can only pay 8,000. So you are right. Bank loan, Mugu Bank. So Mugu Bank into brackets, loan. So I'll put the 8,000 here. We can only give him 8,000. Yes, because he gave us 10,000 out of the 23,000 loan that we have. And he secured it on what? 8,000 on a freehold land and building. And that gives us 8,000 proceeds. So that means 11 other loans. That's 13,000. And we were told that the other one too also secured on a particular property. So let's go and pick that one also. So the other loan, that's the last footnote. Okay, last but one. Here, let's start from the second sentence. The other bank loans, other than the loans from Mugu Bank, were secured as a fixed charge on plant and equipment. So that means the other one, the 13,000 was on the plant and equipment. And that one they had what? 15,000. When they sold, or if you sell it right now, we get 15,000. So that one is more than the proceeds coming from the collateral is more than the other loan. So that one we can go ahead and pay all of them. So right here, other loan, all of them are fixed charge. Other loan. So this 13,000 agreed. Perfect. So this is how it will look like. So under the liability with a fixed charge, there are 2, Mugu Bank loan and other loan. You are done. So So it means that with the Mugu Bank, it left with 2,000. That 2,000 is what? Unsecured liability. So they should wait. If you are sharing or paying the unsecured liability, they should come and then join the queue for that 2,000, and then you are done. Perfect. Now let's move on. Number 2. What's the second one? The second person on the list to be paid from, that's the receiver's money, right? So I'm continuing from this section. Receiver's money. Cost of what? Liquidation, right? Or liquidation expenses. So liquidation expenses, the next one. So liquidation expenses. Do you come across something like this in this question? No liquidation expenses, right? So dash. The third person that will be paid is who? Preferential liabilities. So preferential liabilities. And also dash. Examples of preferential liabilities: tax, rates, and wages and salary owing. Then next one is who? Floating charges. So liability with floating charges. Liability with what? Floating charges. So that one too. It says something like that. One of them carries a floating charge. Let's go to the question. Liabilities with floating charge. It says something like that. The bank overdraft has been secured as a what? Floating charge on all the assets. So let's go and pick the bank overdraft. Where is the bank overdraft? Bank overdraft. The bank overdraft is what? 11,000. Perfect. So the bank overdraft is 11,000. So here I write the bank overdraft. So bank overdrafts. It's 11,000. So I'll bring it here. Then we go to the unsecured liabilities. But before you go there, can you know the balance left first? So adding 8,013 plus 11,000. You shift it here so that you know the balance. So that if the balance be enough to pay the unsecured liabilities, so that if there's a need for prorating, you do that. If there's a need for prorating, you do that. Now take note, let me mention this. For the preferential liabilities, some of the questions, or in some cases, when you see sundry payable or sundry creditors, the examiner might inform you in a footnote that the sundry creditors represent an amount owing to the tax authorities and Senate. But in this question, we don't have something like that, so we move on. Yes, iodine, and one of the question we have. So take note of that. So kindly let me have the total. So all, adding all, so far we've paid 8,000 plus 13, 21,000 plus 11,000. So making 32,000, right? So you write it here as 32,000. You subtract it from the 44. Then you left it what? So 32 minus 44, that's 12,000, right? So left with 12,000. So this is the balance left for unsecured liabilities. So balance left for unsecured liabilities. So you come unsecured liabilities. Unsecured liabilities. So now you pick the question paper again like this. You go to the non-current liabilities. All the liabilities left, write them there. Just their names. Just their names for security reasons. Now the very first person on the list must be Mugu Bank. Why Mugu Bank? Yes, Mugu Bank. Because the money that the Mugu Bank gave to the company is 10,000, but they've paid 8,000 here. So let's be 2,000. So that 2,000 must form part of what? The unsecured. Into bracket, the remainder. You've paid 8,000 or 8 million out of what? The 10,000. So take notes. Then what do you do next? The next person on the list, we are down the bank loan. You go to the current liability. We paid overdraft. So left the two people, trade payables and sundry payables. So trade payables, let's see if that's all. So let's get it here. So let's go on the face, friends online. So the current liability, the bank loan is exhausted. You've used all of them. Overdraft, you paid it. So left with what? Trade payable and sundry payables. So write their name here, trade payable and sundry payables. Now write their amount somewhere. Don't bring the amount here. Now this amount they are 2,000 for Mugu. Trade payable is 10,000. Sundry is 4,000. So 2,000, 10, 4. Please don't write 2. If you add all these, you get what? 16,000. Wow. But meanwhile, the funds left is not enough. We only have what? 12,000. So that means we have to prorate it. We have to share. We have to share this money. So that is it. So we have to what? Share. So how do you share the money? It must be prorated on the proportion of what you have. So that means to get that for Mugu Bank, I'll take what they have now, 2. So it will be 2 divided by the 16 times the 12,000. So that's how I'll do the sharing. This guy, the trade payables will take 10 times 12,000 all divided by the 16 in that order. So let's do that. So kindly do or go by this approach and you will be fine. Kindly take notes of that. So prorates. So let's share. You can do the calculation somewhere and bring the answer in. So let's work it somewhere and bring the answer in. So first, which part of the board should I clean? So we are down this section, so I can take off this section. So I'm taking off this section. Or let's work out here. So Mugu Bank will be, so let's work for Mugu Bank. So Mugu Bank will be 2,000 all divided by the total amount, or the total debt left, which is 16,000 times the amount left, 12,000. This is what you get. So 2,000 out of this, so that's 1,005. Perfect. So Mugu Bank will get 1,005. Then let's go to that of trade payable. They have 10,000. So that just clean the top. Change it to 10,000 out of the 16 times the 12,000 left for us to share. We are sharing 12,000 to them. So that one too will be 7,500. So that we trade payable, they also take 7,500. Finally, the sundry payables, their value is 4,000. So just be changing this one. So they also take what? 4 out of this. So that's 3,000, right? Perfect. So 3,000. You are done. So that's the workings, how we got these figures. Please, in exams, kindly show the workings, open a bracket, leave a space beneath it, do that workings there. Open bracket. But my board is too small. So sum them up, shift it here as 12,000 and do the necessary arrangement. Although the examiner asks specifically to the bank, but you have to complete it. Great. So whatever left, dash. We call it what? Available for who? So available for the preference and ordinary shareholders. Preference and ordinary shareholders. So whatever remains will be for that's available for preference and ordinary shareholders. They are going to take. In fact, that means they are getting nothing. Then you move down. You write preference shares. Then finally, please the preference shares, put them in brackets. So dash in bracket like this. Whatever remains goes to the ordinary shareholders. Then you are done. So that's the end of the statement of what? Liquidation. So that is the end of the game. Then when you are done like this, you go and do the analysis. So let me put the ordinary shareholders here. So preference share, ordinary share, but they are getting nothing because the money was not worth enough. Great. Now, when we are done, we have to look at the position before we can write the advice. Because they say we should advise Mugu Bank. Good. We should advise Mugu Bank of their position. Great. So let's go and do the position. With the position, let's go to the top small. Then let me clean here. In fact, for this particular question, the examiner is interested in only Mugu Bank position, but they ask you to advise Mugu Bank. But for purpose of teaching, I'll do for all. So position, still at A. So position of key stakeholders. So position of key stakeholders, not everybody. Keyword stakeholders. Key stakeholders. So what do? You write the stakeholders here. Then write the position before and your position after. But this I'm taking all the space, so that's why I like the shortcut too. It's not advisable in the exam, so let me shortcut it there. So stick order, your position before, your position after. Wow. And then loss payout liquidation. Loss per liquidation. So that is it. So as usual, you write all the key stakeholders. Let's start. Don't forget the OD shares, ordinary shareholders, preference shareholders. Then please, for the purpose, write Mugu Bank. Mugu Bank. And write other bank loan. Other loan. Then you go to the current liabilities. The current liabilities, there are three. We have bank overdrafts. Bank overdrafts. We have account payable, trade payable. We have trade payable. We have sundry. That's the accrual, so sundry payable. Okay. Do you have preference dividend in arrears? Let's look at the question. Preference dividend in arrears. So if you have preference dividends in arrears, we bring that one too. Do you have preference dividend in arrears? So let's see preference dividend in arrears from the question. No, they didn't say something like that. I think no two. No dividend was declared on preference shares for the year ended. Yes. And they didn't tell us whether it's in arrears for 2 years, so we will not assume anything. So let's go straight. So position before ordinary shareholders, what's the value? Let's pick it. So ordinary share, their value is 30 million, so that's 3,000. This one is 1,000, right? 10,000. 30,000, 10,000. That is it. So 30,000. Don't forget your three zeros, three zeros, three zeros. 30,000, 10,000. Mugu Bank, they give 10,000. So their position is 10,000. Don't forget Mugu Bank. The loan that they give to the company is what? 10,000. Other loan, we said that is 13,000. Good. Bank overdraft. Let's go and check the bank overdraft. I forgot the figure. It's a floating charge. That's 11,000. Oh. Bank overdraft must be 11,000. Bank overdraft, yes, 11,000 this year. The bank overdraft is 11,000. Trade payable. Trade payable to was 10,000. Then salary payable 4,000. That is all. So what's the position after? Ordinary shareholders, they are not getting anything dash. So their position is here. Pick the one in the statement of liquidation. How much did you give it to the ordinary shareholders? They are getting dash. Preference shareholders, they are getting dash. So dash again. Preference shareholders, they are getting nothing. Then Mugu Bank, how much are you giving them? First, we give them 8,000 here. And again, we give them 1,005. So putting these two together, Mugu Bank will receive what? 9,500. First, secured. Second, 1,005. So Mugu Bank had 9,500. Other loans, they had their money intact. Other loans had their money intact. Bank overdraft, they had their money intact. Nothing. Trade payable, how much do you give them? Trade payable, you give them 7,500. So they had 7,500. Sundry payable, how much do you give them? We give them 3,000 instead of the 4,000. Now let's calculate the loss per liquidation. Loss per liquidation is this minus this. Put it here. Ordinary shareholders, they are losing everything. The entire 30,000 gone. Preference shareholders, they are losing the entire 10,000. Mugu Bank, they will lose 500. Other loans, they are not losing anything. Dash. Bank overdraft, dash. Trade payable, this minus this. They are losing 2,500. Salary payable, they are losing 1,000. We are done. Putting all the loss together, we have a total loss of total loss of so 30, 10, 40, 500, that's 3,000, 4,000, so that's 44,000. Wow. What coincidence. 44,000. What a coincidence. History must repeat itself. So the total loss, we are done. Write the advice. Now advice Mugu Bank. Advice what? Mugu Bank. So now that I can clean all this. That's what I was waiting for. Now write the advice. All of this is for the 5 marks, so we have to be fast. Advice. advice to Mugu Bank. What will be their position? Only Mugu Bank go. They say circle them. Circle them. So Mugu Bank. Let's continue the game. So what will be the advice? So in event of liquidation, Mugu Bank will lose 500,000 of their investments. So will you advise them to push for liquidation? No, they shouldn't. So because if they push for liquidation, they will lose 500,000. So the advice will be that let's put something small together for the advice. For the advice. Great. Let's put something small for the advice. So here, the question was in 2/4. Don't forget the question was in 2/4. The question asks us to advise Mugu Bank whether they will support the capital reduction or force for liquidation. That's the advice. So you're advising Mugu Bank whether they should support the capital reduction scheme or they should push forward for forced liquidation. This advice, it must be in 2/4. So first, all right, from the above, Mugu Bank Limited. Limited. So Mugu Bank will lose 500,000 upon liquidation. Upon liquidation. And hence it should support the capital reduction scheme. The capital reduction scheme if it will offer a better position or the loss per the scheme is minimal than the 500,000. That's all. So from the above calculation, or from the above, Mugu Bank will lose 500,000 upon liquidation, and hence it should support the capital reduction scheme. If it gives a minimal loss than the 500. Yes, they should only support the capital reduction scheme if the loss per the scheme will be lower than 500. That's the advice. That's all. If the loss per the scheme is 600, they should force forward liquidation because upon liquidation, they are getting 500. Your scheme is, they are losing 500. Your scheme suggested that they should what? Sacrifice 600, so they will not agree. Oh, sorry, they will not agree. So basically, that is it. So we are done with the step 1. Let's quickly go to the step 2 or the B part. Everything you've done is for 5 marks. So you have to be fast, smart. Of course, don't need all this. You need only the bank section for the position of the key stakeholders. Great. Now to go over everything, we are saying that the advice here is not as straightforward. The advice is conditional because you don't know what will happen to that of the capital reduction scheme. So you can't tell them that they should force for liquidation or they should support the capital reduction scheme. No, you can't do that. But they say you should advise them. Then you tell them that from the above calculation, you are losing 500,000 from the liquidation, upon liquidation. And hence, you should support the capital reduction if the capital reduction, the loss over there will be less than 500. That should be the advice. So Mugu Bank should support the capital reduction scheme if and only if the loss upon the reconstruction will be less than what? 500. They should go ahead. If the loss is more than 500, they should stop. That's all. Or they will not support the capital reduction scheme. Great. Part of the question. The B part stated that I wanted to this particular question that we solved is similar to this question. Iodine. He said that the company is struggling. Let me kick it from here. The new management team is proposing a scheme of reorganization to reposition the company and make it viable going concern. It has approached their bankers, Natural Bank. Good. So I use Natural Bank here, who owns 85% of the overdraft to waive off 38 million of the bank overdraft. That means here you have to work out 85% of the overdraft. Good. And in the same position too, the bank overdraft here happen to be 500. So 85% of this. Good. That'll be around 450 or so. Then if you go to the requirements, they say advise Natural Bank of its position in case of liquidation and explain whether to accept the loss proposed by the new management for 5 marks. Great. Now let's go to our main question for the day. So this will be a trial one. This is in the material that I uploaded, I think, last few days. So it is a remix of iodine. So take note. Now let's go to our next question for Mugu Bank. Propose a scheme of capital reduction for consideration by the board of directors of Brighter Days Limited. That will be accepted to Mugu Bank Limited. Good. So let's go to the scheme. Before Mugu Bank will accept this scheme, give them a loss which is lesser than 500. That's all we are looking for. So we check your sharing of the loss or the sacrifices and see which amount you give to Mugu Bank. So that section will be the B. So let's go to B. We tell it designing of capital reduction scheme. So designing of capital reduction scheme. So first, I write here B. So, nearly say B limited. So B. So I write here capital reduction scheme. Now I need to go through the 6 steps, but because we have done the first step already, so I have to continue from the next step, the determination of the maximum loss. I don't need to start from liquidation again. No, because I've done liquidation. Take notes. So let's quickly go to determination of maximum loss. So B, I will call it maybe I. Determination of maximum loss. We also call it the capital loss. So that is it. You can also term it as the maximum capital loss. Wow. Or just maximum loss to be on safer side. Maximum loss to be on safer side. Maximum loss. How do you get a maximum loss? Let's keep it simple. So let's go to the format. Now we said that here the losses are two. The one that captured in the book, which is made up of assets and the capital, the retained earnings, so the income surplus. Then two, losses that are not in the balance sheet, the other. There are also three. So basically, that's what we are going to talk about. So let's see. First aspect, right here, asset losses coming from where? All the assets. Right here, the book value or the carrying amount. CA, chartered accountant, come again. Right here, the going concern value. Going concern. And then you have to select. Then the maximum loss. Here you are showing working how you arrive at this. So the first one, write all the assets. So here, write all the assets except cash. So let's write all the assets. So first, freehold property together with their values. Freehold properties. Then you go to plants and equipment. The next one is furniture. The next one is investment, right? The next one is development expenditure. Development expenditure. The next one is all assets except cash. Inventory, but there's no loss. Now will be incurred as a result of what? Cash balance. No. Then trade receivable. Don't forget trade receivable. What again? Cash. No. If you have 1,000 Ghana and you are struggling, would they say that 1,000 Ghana they are reducing it? No, we won't do that. So take note of this. So let's go and pick the asset values. So all of them are there, 15,000 up to 13,000. Please do not include cash and bank balances, not at all. There are no losses coming from cash and bank. If you are doing reconstruction and you have 1,000 Ghana, it is to be 1,000 Ghana after the reconstruction to not reduce. No sacrifices will come as a result of the cash. So first, the book value should come here. This is the book value, the current amount or the book value. So copy all the book value. So first on the list, 15,000. Second, 18,000. Next, 8,000. Next, investment is 9,000. Next, government expenditure is what? 13,000, right? Next, inventory is 7,000, right? Next, receivable is 5,000. Then we go and pick the going concern values. We said that the going concern values must be what? The going concern values have to be with that of for the recoverable amount. I don't talk plenty. So let's select the recoverable amount. So freehold land and building 18,500. So 18,500. Then plant is 16,000. Then furniture and fittings is 7,500. Furniture and fittings 7,500. Then let's go and record the maximum loss. Let's go and record the maximum loss. Good. Let's go and record the maximum loss. Great. Let's go and record the maximum loss. Now the maximum loss for these items will be, we can find the going concern for all of them before we look for the maximum loss. Investments. They said they will sell the investment for 5,500, agreed. So the investments happen to be 5,500. The investments happen to be 5,500. So let's go and pick that one. The investment is 5,500. Where are you? Good. Investment 5,500. So let me write it down. 5,500. Then what again? It is not probable that the development expenditure will generate any account benefits. So development expenditure dash. There's no going concern value. So it must be scrapped off. Okay, then what again? Inventory. It's an inventory has some obsolete goods. So it has been included, which is amounting to 2 million. And then receivable, 10% is what? Recoverable. So here 2,000 will be gone. So left with 5,000. Inventory left with 5,000. This one to 90% of this, 10% is 500. So left with 4,500. Now let's calculate the maximum loss. Then we are done. So when I'm done, you put the question paper down, like the way I'm putting my own down. This minus this, let's put it down. 15 minus 18,500. You put the answer here. Negative means gain. So 15,000 minus 18,500. What do you get? 18,500. What do you get? Great. You get 3,500, right? Agreed. So 3,500 negative. This and this loss of 2,000. This and this loss of 1,005. This and this loss of 3,500. This entire loss of 13,000. They are losing everything. This and this, they are losing the 2,000. This and this, they are losing 1,005. Putting all this together, we say this is the losses coming from the assets. Then you have arranged it like that for him. Losses coming from where? Assets. So that's the losses coming from assets. So putting all this together. So this 3,535 cancel. 3,500 plus 13, 16,500, 18,500, 19, 20,000. Agreed. Hey, where from the trade receivable? It's supposed to be 500. Oh, sorry, it's supposed to be 500. Trade receivable is 500 though, because 5,000 minus 4,005. What do you get? So that's 500. Adding all this. So 3,005, 16,005, 18,005 plus 500, making 19,000. Agreed. So the losses coming from assets is what? I'm getting 19. Oh. Right. Sorry, and the furniture must be 500, right? Thank you. So 18,000 should be the right answer. 18,000. Perfect. Then we are done with the losses coming from assets. Then you go to the income surplus. Then you cancel that one too. So let's go and bring the income surplus. The income surplus that they had happened to be income surplus to be 12,000, right? Perfect. So I have to write it off. Income surplus is 12,000. So I write here income surplus. So income and then the surplus. Income surplus happen to be 12,000. Is there any other loss again coming from the footnote? Let's go down. Any loss coming from the footnote? So let's go to the footnote and see if there's any loss coming from there. Preferred dividend in arrears. We say here there's no preferred dividend in arrears. Reorganization expenses. There's no reorganization expenses here. I like that. So here no free figures. So we are done. So the total maximum loss that they have to scrap off must be 30,000. So 30,000 need to be scrapped off. You are done. That is the end of the game. We move on to the next step. Share the maximum loss. Get the resources, propose the scheme, prepare your balance sheet, the new balance sheet, and that's the end of the game. Now let's continue. So right from here, we have to share the maximum loss. So let's go and share the maximum loss of what? 30,000 to the key stakeholders. Please, I like writing at this side, so I'm going to dash the board. So the next stage is to share this maximum loss. So let's go and share. We are still at the B part. Let's go and share the maximum loss to the key stakeholders. So let's see, to the keys. Now let's critically analyze this position very well. Have you seen these cumulative preference shares here? You know that for preference shares, they have to, it's a must. For the preference shares, the dividend on the preference shares must be paid, how do you call it? It's a fixed. Whether you earn money or not, that one it must be paid cumulatively. Whether you declared it or not, it must be paid. So you have to take note of that. So this is a smart game. No dividend was declared. So that means they are owing about 1 year dividend. So we can include it in the maximum loss. Take note. So 12% of the 10,000. That's the dividend in arrears. So having a smart way to determine the dividend in arrears. So here's in arrears just for 2019 because they've not declared it, so they are owing. And you know, preference shares or cumulative preference shares, the dividend is fixed. Whether you declared it or not, you have to pay. Whether you declare the dividend or not, you have to pay. So let's add. So let's calculate 12% on 10,000. That will give us. So 12% on 10,000 will give us just for 1 year. So times 1 year. So that would be the dividend, preferred dividend in arrears, if you should do that. That would be the preferred dividend in arrears, if possible. If possible. So take note of that. That for dividend, whether you declared or not, you have to pay. It's a fixed. It's not like ordinary dividend, which that one it must be declared first before liability start there. So that's 1,200. So it means that our total maximum loss should be 31,200 agreed. So that's the preferred dividend in arrears. So that's why I've not cleaned it too. So that's how I stopped. So 31,200. 31,200. That'll be the total maximum loss. So we should create a column and then add 1,200 to it as a loss coming from the footnotes. So we are done. So let's go and share this loss. So we are still under the scheme. So call it share of maximum loss. We have to share the loss. Write the stakeholders here. So let's start with the key stakeholders. Others. So let's see. Let's write all of them. Tell them that this is a loss per liquidation. Loss per what? Liquidation. And then this is a loss share of maximum loss. Share of maximum loss. Now list all the stakeholders here. So don't forget, you can get this table from where? Out of the liquidation. So ordinary shareholders, preference shareholders, then you move on. Here Mugu, right? Good. So Mugu Bank, who again? The other loan, other bank loan, bank overdrafts, trade creditors, that's a trade payable. Who again? Mention them. Sundry payable, right? Sundry payable. Then almighty dividend in arrears. So the dividend in arrears. The dividend in arrears. Just 1 year. Okay. That's a smart game. Let's see. Ordinary shareholders, they lost the liquidation, but they lost everything, which was 30,000. These people lost everything. Mugu lost 500. Other loan, they lost something like other loan. They lost, but they didn't lose anything. No. They did not lose anything. Bank overdraft, they didn't lose anything. Trade payable, they lost 3,500. Sundry payable, they lost something like 1,000. Dividend arrears, they'll lose still 1,200. You total all this, we had 44 there. So if you total all, you get something like 45,200, right? That's the total loss. There was a total loss per the reconstruction. That is the 31,200. This must be shared. Let's go down, sorry. This must be shared. So how do you share this 31,200? We said, first of all, those that will dash, go and throw the dash there. Have you seen? Repeat it too. Those that will dash, repeat it. Those that will dash, repeat it. Second, dividend in arrears, cancel it. So dividend in arrears, 1,200, gone. So let me 30,000, right? Should you give all to the ordinary shareholders? But if you give all of them, all to ordinary shareholders too, that means you are not being fair. You are not being fair. What about the preference shareholders? Please, here is discretionary. Just that do not give or allocate any loss to someone which is more than the loss per the liquidation. So take note. So discretionary. So now, friends online, you can tell me amount that I should use for ordinary shareholders. So discretionary, I'll put 25,000 in there. You should sacrifice 25. This guy should sacrifice what? 5,000, right? Yes. Yeah, sacrificing 5,000. So half of your money gone. Discretionary. You can also say that, okay, this guy lose 3,000. The remaining one, the thing is 30,000, right? So that will be 27. Yes, you should lose 27. Discretionary. And then someone say, okay, this guy lose 400. You lose 600. All these three people, they should lose 1,000. So let's make it 500, 300, and 200. Perfect. So the loss is minimal. They will not complain. Discretionary. So now we are going by this. Dash here, dash here, dash here. So that means the trade payable, they are not losing anything. Sundry payable too, they are not losing anything. Preference shareholders, they are losing 5,000. Discretionary. Perfect. Or you can say that these people should lose, let's say, 4,000, right? Yes. This guy should lose just 100. This guy should lose just 500. And this guy should lose the remaining 400. Perfect. It's fair. It's fair. Everybody is losing something. Just that it should not be more than upon liquidation. That is all. So any discretionary view is allowed. Here is subjective, whatever it states. What we don't want is this. If you put any figure here, even if it is 1, you put 2 here, it's totally wrong. They are not losing anything upon liquidation. So per your scheme, make sure that they don't also lose anything. Other than that, they will force for liquidation. Good. So take note. So dash dash. And this guy, it should not be more than this. You are done. So that's the scheme. Or you can also go by the first approach that we selected. All these people will not lose anything. Then this guy will bear the 5,000. Perfect. Wow. Okay, so I think I'll select this position. So let's move on. We are done with this position. We are done with this position. We are done with this position. We are done with this. From here going, everything is what? Discretionary. From here going, everything is what? Discretionary. Take note. From here going, everything is what? Discretionary. Now let's move on to the next step. This is the heartbeat. Resources requirements. So I resources requirement. Then we write the scheme. With the resource requirements, we stated clearly that first, all what you have to do is you write your receipt here, and then payments. I think the payments should come first, then your receipt down. So payment, then receipts. What are you going to pay this time round? Yeah, they are not buying assets. This company is not buying assets. So payment, and there's no reorganization expenses which must be paid. Wow. The current liabilities, there are three. Let's pay at least. You say we should pay all current liabilities and leave one, right? Discretionary. Pay all current liabilities and leave one. Discretionary. You can also maintain them. You can also maintain them. Okay, so if you are going to pay all of them and leave one, which of them are you going to pay? Pay the one that they are losing and leave the one that they are not losing. Pay the one that they are losing something, leave the one that they are not losing. So bank overdraft, they are not losing anything, so I'll not pay them. Oh yes, if you are not losing anything, let me use your money to trade a little. But the trade payable, we said they should lose 500. Sundry payable, they should lose 400. Okay, so it means that with the trade payable, they will lose 500 and we'll pay the remaining balance of what? 2,000. So right here, trade payable, that means I will pay them. Discretionary, you can maintain them. So trade payable. Payment, you open your brackets, tell the examiner that their position before. What's the position before? The trade payable. Their position before. Trade payable. Their position before. We pay, we take 500 from it, then we pay the remaining balance to them. So let's quickly do that. Let's go to the sheet. Trade payable, trade payable, trade payable, trade payable, trade payable. Their position is what? 10,000. So we are paying them. So that means, but they are losing 500. So we pay them 9,500. And sundry payable, we said they should lose 400. So that one, we pay them 3,600. Perfect. So whatever you are losing, take it off from their position and pay them. Please and please again, from here going, it's discretionary. So try and create something for us, okay? Try. By create something which is true, something which is true. So minus 500. So that's 9,500. Then you go to sundry payable. Sundry payable to their position was 4,000 minus 400 that they are losing, 3,600. Then here, the only thing that we have to bring is what? The working capital requirement, which is what? A balancing figure. Working capital requirements. Working. So we'll do the working somewhere. In fact, I'll do it on top here. I'll go and do it and bring it back. In fact, the receipts over here, you sum all up. In this question, you were told that specifically that the shareholders are willing to contribute all the money. So here, the money should be borne by what? The shareholders, plus the assets that they are going to what? Sell. So that's all. So in the receipt section, you only have to show what? That of the shareholders. So receipts and the other asset that they are going to sell. But let's go and calculate the working capital and bring it. So let me underline here. That is another working capital requirement. Working capital requirements. First, You list all your assets, your current assets and your current liability in the new business. First, you can start with the current liability. So I'll start current liability. In the new business, we said that we should pay all current liability except one. So that means in the new business, it's left with only bank overdraft, which is 11,000. The bank overdraft is what? 11,000. That's the only thing left. 11,000. Bank overdraft will be 11,000. Good. The bank overdraft is 11,000. Perfect. So that's the only current liability left. So the total current liability will be the bank overdraft of 11,000. You write it. Then you come to the current assets. Now the current assets in the new business, we expect them to be 1, inventory. 2, the trade receivable. Then 3, your cash. Then the working capital requirements. Perfect. So let's go down small. So cash, if there's cash in the question. So here will be cash. And here will be working capital requirement, the balancing figure. So let's see. Inventory in the new business, what will be the inventory value? Inventory value in the new business. We have to pick the going concern value. It was 5,000. We have to pick from going concern value. Inventory was 5,000. Okay. Then what about the receivable? The going concern figure was receivable. It was 4,500. Receivable was 4,500. The new business receivable was 4,500. Kindly confirm for me. Cash balance. The cash balance is 1,000, right? Let's bring the cash balance 1,000. Cash balance is 1,000. Then you leave a space between the cash balance and then you total it. So that's the working capital. Good. Now, what's the working capital ratio? So first, total all the current assets, leave a space for the balancing figure. Then you go and pick the working capital ratio. So the ratio is what? 2:1. You are giving 2:1 here. So 2:1. Perfect. So that 2:1, what you have to do is you come here. That means just multiply it. The 11,000 by 2. You get what? 22,000. So here will be 22,000. So putting all this together, so you underline it and write the 22,000, but I don't have space there. The 22,000, okay, let me shift it there. Let me go and do it up there. So let's assume that this is the 22,000. If you underline it, you get 22,000. Kindly add all this. If they are not equal to 22,000, the difference represents what? The working capital requirements. So working capital requirements. I wish I can do it top there. So the difference. Good. So 11,000 times 2. That will give us 22,000. So we sum all up. If it's not equal to the 11,000, the difference will be 11,500. So that means when I sum all up, I have to write 22,000 there. How do we get the 22,000? So let me do that one here. So total current assets, so it will be 11,000 times 2, because the current ratio is 2. Great. 2:1. So the difference, that means working capital must be 11,500. You are done. That is all. So working capital is what? 11,500. So we are down the working capital requirement, 11,500. It's a balancing figure. It's the one that you add so that you can get what? Get 22,000. So come here, you can put 11,500 here as the working capital requirement. That is all. So you sum all up, look for the one that they have to pay this. So, and here do not ask any money from the preference shareholders. Yes. So can I take this section for us to complete the game quickly, and we will finish soon. So that is it. Okay, so let's take it off. We are done. They are going to write right after this stage now the proposed scheme, then the balance sheet, then that's the end of the game. So sum all up here. So that's all give us 20,000, 21,000. So that's 24,600. Agreed. 24,600. So receipt. Here they will sell their investment, so they'll get money. Investment, they will sell it, they'll get money. When they sell the investment, they had 5,500. And then the remaining balance should be paid by what? The ordinary shareholders, because they say they are willing to contribute additional money. So let ordinary shareholders bring the remaining money. Ordinary shareholders bring the remaining money. So find the difference between 24,600 and this. So the total still must be 24,600. It must balance. If it does not balance, your financial position too will not also balance. Good. So that's 19,100. Perfect. So it means that the ordinary shareholders must contribute 19,100. Then we are done. Now let's write a scheme. So the scheme, 7 points, maximum of 10 points. Good. Just 7. Write 7 statements. And that 7 statements you start like this. What they should lose, what they must bring. What they should lose, what they must bring. What they should lose, what they must bring. That's all. 7. So how many? 1, 2, 3, 4, 5, 6, 7. That's all. You are done. So 7. Talk about them. Then you are done. So let's write a scheme. So that's the next section. But because we are going to use this, I don't want to clean it. So I'll dictate it, and as usual, you write it. In fact, even in the handouts, there are a lot of schemes which has been written. So we just go and then pick the structure stated in the handout. So for instance, the question that we solve, Asampa Limited. So if you go to the scheme, so this is how you want it. So write on top, proposed scheme. Number 1, ordinary shareholders. Then you underline it. What they should waive off and what they should bring. What they should lose, what they should bring, what they should bring, what they should lose. You are done. No confusion. Okay. So let's do the same thing here. So here, let's start with the ordinary shareholders. So proposed scheme. So let's write the proposed scheme. So that's IV. Proposed scheme of reconstruction. So ordinary shareholders, let's see. They are losing what? 25 million. And they are bringing what? 19.1 million. That is all. So if you write ordinary shareholders, so here write number 1 on the list, ordinary shareholders. Then I'll underline this. Now I'll tell the examiner. The ordinary shareholders should agree to waive off 25 million of their investment and subscribe to new shares amounting to 19.1 million. We are done. That is all. So ordinary shareholders, they should agree to waive off 25 million and subscribe to new shares amounting to 19.1 million. That's all. We are done. So one, gone. One statement, gone. So one, gone. Number 2, preference shareholders. They are losing what? 4,000. Are they bringing money? No, they are not bringing money. There's another preference dividend in arrears. That's all. So number 2, preference shareholders. They're right. So like how we've stated it here nicely. So please, the arrangement must be like this. Why are you? Good, arrangement must be like this. So write preference shareholders. The arrangement must be like this. The one you're going to talk about, you write it nicely like this. Good. That's how we want the arrangement should be. Good. Now we are going to the preference shareholders. The ordinary shareholders, we are repeating the ordinary shareholders. They should agree to waive off 25 million. Please, you have to write it like this. 25 million. That is 25 million. They should agree and waive off 25 million of their investments and subscribe for new shares amounting to 19.1 million. Pardon. Then the next person, preference shareholders. First, 4 million of the preference share must be cancelled. 4 million Ghana cedis of the preference share capital must be cancelled. And all the preference dividend in arrears must be cancelled. All the preference dividend in arrears must be cancelled. You can also state that and the 2019 preference dividend must be cancelled. Good. So the preference shares, when you go there, tell the examiner 4 million because we raised 3 zeros. So 4 million of the preference shares, 4 million Ghana cedis of the preference shares must be cancelled, and all the dividend on the preference shares must also be cancelled. You are done. You are done preference shares, so 2 gone. Left with 5 points. You are done. Please don't write plenty. Here, what they should lose, what they should bring. That's all. What they should lose, what they should bring. That's all. We go to the next person. Mugu Bank. Mugu Bank. Right? Mugu Bank. Mugu Bank will be 100,000, right? Then there are 3 zeros. or 0.0. This one will be 0.1 million. So 0.1 million, 0.1 million. Once I'm done with preference and then ordinary shares people, I can claim their own. So I can write Mugu Bank here. So the third one is Mugu Bank. Mugu Bank and other bank loan. Other bank loan. Mugu Bank and other bank loan. That's the third one you're on the list. So that one's on the line. First sentence, Mugu Bank. They should sacrifice 100,000 of their investment. So Mugu Bank should agree to waive of Ghana cedi of 0.1 million of their investments. Full stop. Yeah, done. I'm done with Mugu Bank. Or we can continue with the remaining balance being secured on what? They have secured their own on. They have secured their own on the. What's the name? They have secured their own on the land and building. Yeah, so secure on land and building. So we tell them that with the remaining balance being secured on land and building. We want to know. In fact, Mugu Bank, their amount has been secured on land and building. Yes, the company land and building. So you can go ahead and tell them the remaining balance should be secured on the land and building. Or you can still earn it here. That's all. Then there's other loan. Then the next sentence or the next paragraph, the other loan. So the other loan, they are not losing anything though. So other loan, they are not losing anything. So don't tell them that they should lose. Tell them that it should be secured. It should be secured on the plant and equipment. So other loan will be secured on the plant, will be secured as a fixed charge on plant and equipment. Secured as a fixed charge on the plant and equipment. No shortcut too. So that's number 3. Give us at least 7. At most 10. So let's go to number 4. Number 4. Number 4. Number 4. Bank overdrafts. Are they losing? They are not losing anything. No. Bank overdraft, they are not losing anything. So what can we tell them? Does it carry floating charge on all the assets? Okay, so we can say something about them. Before to talk about them, they are not losing anything. We are not paying them too. So we can't say that they should pay them. So let's go to the bank overdraft. Number 4.4. The bank overdraft will be secured as a floating charge on all the assets. The bank overdraft will be secured as a floating charge on all the assets. You are done. That is the point 4. Point 4, bank overdraft. So the bank overdraft will be secured as a floating charge on all the assets. So we are now in the bank overdraft. That's the point 4. Bank overdraft, point 4. So point 4 was the bank overdraft. Let's go to point 5. Trade payable, point 5. Trade payable is a point 5. Trade payable is a point 5. Now, trade payable, they are losing what? 500,000, with the remaining balance being paid what? Immediately. That's all. So trade payable, we are paying them 9.5 million. So number 5. The same thing applies to the sundry payable. They are losing 400, so I can take this section off. Let me take it off here. That's what I'm seeing here. I don't like it. So number 5 is the trade payable. Tell the examiner that trade payable. So we say that Ghana city of 0.5 million of the trade payable must be cancelled with the remaining balance being paid immediately. With the remaining balance being paid immediately. So 0.5 million of the trade payable must be cancelled with the remaining balance being paid what? Immediately. Full stop. You are done. You are done with trade payables. Let's go to number 6. Number 6 will be who? Sundry payable. Sundry payable to tell them that 0 dot what? Sundry payable, we had 0 dot sundry payable, we had 0.4. So that one to Ghana city of 0.4 million of the sundry payable must be cancelled with the remaining balance being paid immediately. You are done. That's all. So that's the good. So that's the 6 points. So sundry payable 0.4 million Ghana cedi of the sundry payable must be cancelled with the remaining balance being paid immediately. Let's pay it now. We are done. 11, one item, then that's all. In fact, I will list 7, I will list 10, getting to 11. You don't need to list all of them like this. No. You don't need to list. So I am continuing listing. Once I'm done this section, I can continue here. Number 7. Number 7. Number 7, we can talk about the investments. We are going to sell the investments. So investments. So that note, the investment will be sold. So the investment will be sold. The investment will be sold for Ghana cedi of what? 5.5 million. This one, you are just copying the one in the footnote. It was stated in the footnote, just copy it. So you are done with the investment. So you are done with everything here. Everything here, we are done with it. So we are still going. We are still writing the scheme though. So number 8. Tell us the working capital ratio, or tell us the asset value. The asset value. So tell us what you're writing them off, then you are done. So here you can see that the freehold freehold, land and building, comma, plant and machinery, and furniture and fittings will be stated at their recoverable amount. Will be stated at their recoverable amount. Recoverable amount. Full stop. So this one, we've not done anything. Let me show you where we pick these figures from. We pick these figures from here. From here. So you just have to list them here. Tell the examiner that the freehold land and building, plant and equipment, and furniture and fittings will be stated at their recoverable amount. That's all. Will be stated at their what? Recoverable amount. That's a full note on its own. We are done. Then the next note will be, in fact, all the assets, you have to talk about them, but talk about few. Note 9. Go to the development expenditure. The development expenditure should be written off. Okay, so the development expenditure should be written off together with the income surplus. So here, in fact, we're supposed to write them individually, but let's put all of them together. So development expenditure and the income surplus. And the income surplus must be written off or should be written off. Income surplus must be written off. That's all. Note 10. Note 10. I'll give 11, but you are allowed to select only 7, no, maximum of 7. Your own is 7. Select up to 7. Don't write all these 10 because, in fact, if you like, write 20 or 25, the marks will not be increased. There's no enlargement of marks. If you enlarge your write-up, the marks is still fixed. Yes. So whether you give the 7, you give 10, all of you earn the same marks. Good. So let's go to note 10. Note 10 will be about the scheme will achieve a prudence working capital ratio or a current ratio of 2:1. So tell us that the scheme will achieve a prudence working capital of 2:1. So the scheme will achieve a prudence current ratio or working capital ratio of 2:1. The scheme will achieve a prudence working capital ratio or current ratio of 2:1. Then the last one, please, this one, it must be part of your last one. The last one that everybody must write. The scheme holds a promise of future profits. I like that statement. Let me clean it and write it here. For that statement, I like it too. So it must be your last point. So point 11, I'm writing it here. Tell the examiner that the scheme holds a promise of future profits. You are done. It means that when they accept this scheme or when they implement this scheme, in future they will get profits. That's all. And that's the end of the proposed scheme for 10 solid marks. Starting from the B to here, 10 solid marks. You are done. Now, what left is the resultant statement of the financial position. As usual, You take that section and prepare the financial position for me. Then kindly forward to me when you are done.